Welcome back. I'm here with Ben Gossack from TD Asset Management. We're talking about U.S. banks now, and one of the things I love, I've never had a guest do this, so I have to let people know. One of the things you have to do often when you're on a show like this is you want to make sure that, what they said the last time they came on is in tune with what they say this time. You've actually brought a chart to compare what you said last time about U.S. banks to the catalysts of what are happening with U.S. banks. So first, 5 gold stars for that. That's the first time that's actually happened with a guest. You had some catalysts that you thought were going to be important for the U.S. banks. Let's bring up the chart so we can show people in terms of what you thought they were and maybe how important they were then and now. So the first one is rising interest rates.
Right. So back in March, came on very bullish about the U.S. banks.
Yeah.
I want to point out we're still very bullish about the U.S. banks. The catalysts for the U.S. banks are the same as they were back in March, and the importance of them has shifted a bit.
Yeah.
But it's rising interest rates, it's corporate tax reform, it's regulatory reform, and return of capital. We have had hikes from the central bank in the U.S., the Fed. We have 2 in the bag. There's some debate about the last one, and we have an unwind that's going to happen at the Fed. They have $4.5 trillion in assets that they're trying to unload. This could increase interest rates. We kind of know the story about corporate tax reform. It was supposed to happen after healthcare. We know the outcome of that it's just hasn't happened. And we were promised some corporate tax reform by the end of August. It's August now. It's now being promised at the end of the year. I think the most important perspective is that it's not priced into the stock. So if we were to get corporate tax reform, this would be huge for the banks. They derive most of their revenues domestically in the U.S. But if it doesn't happen, that won't take the stocks down. Yeah. I think the 2 really big things that have happened from March till now,
regulatory reform,
is that we have more clarity, and it looks like regulatory reform is more achievable. We never expected Dodd-Frank to get repealed or replaced. What is interesting about Dodd-Frank, it's a very broad bill. But it gave a lot of powers to the supervising agencies to enforce and interpret those rules. Mm-hmm. And so we are getting sort of a turnover at the leadership level for the supervising agencies, which sets the tone. And these agencies have come to the realization that they went a little too far in pushing the pendulum on trying to create safety for the banks. So we think there's a lot that can be achieved in terms of relief, in terms of regulatory measures that sort of trap capital or liquidity at the banks, which then could be turned into earning assets. And that doesn't require congressional approval. I'd say the other really big catalyst is the return of capital.
And why?
So every year the banks have to get their dividend increases and share repurchase plans approved by the Fed. In order to do that, they have to pass these really severe stress scenarios, and whatever capital is left over gets returned to shareholders. We had optimism for this year's stress test, and it was even better than we expected. So just to give you perspective, the payout ratios went from 80 to 100% for the banks. And they're going to be returning to shareholders about 8% of their market cap over the next 4 quarters. And because they have so much capital, they can sustain that rate for the next few years. So as a shareholder, you're getting almost 25% return of your market cap in dividend increases and share repurchases.
Okay, so that's the catalyst, let's say, for the entire sector. Within the sector themselves, I know you've got an opinion versus some of the big banks versus some of the small ones, because I know coming out of, again, the election when it happened, a lot of people were looking to the smaller banks. And what will you tell us? What was the reason why they liked them, and why are you kind of going, no, maybe not so much now?
So coming out of the election, you could see that the smaller banks, their stock prices were outperforming the larger banks.
Yeah.
And a lot of the smaller banks weren't growing their asset bases, because if they got too big, then they fell under some of these sort of regulatory oversights. So they were trying to avoid that because that's expensive. And so there was hope that these oversight levels, their threshold would increase, and that these banks would all get bought up. So people were buying these banks in hopes that somebody else would take them out. I think we're seeing a lot of paradigm shifts because of digital innovation. And so for a large bank to grow, they don't need to buy another bank.
And also they get, when you were talking earlier, they get
branches.
Which is not what
the trend is to reduce our branch load, because we've spent so much on our digital technology that we gain efficiencies by having more people on our apps than in our branches. Mm-hmm. So if I buy another bank, I get more branches that I don't need. Mm-hmm. And so it's these smaller banks will then have to merge with each other. And any of the gains that they get by merging their branch has to then get reinvested in order to keep up with the larger banks and in order to provide a digital experience for their customers.
Fascinating thesis. So out of that, what banks do you like? What U.S. banks do you like?
Okay, so again, we like these banks because of the broad catalyst that we talked about. They're very sensitive to rising interest rates. They would benefit tremendously from corporate tax reform and from return of capital. So the banks that we like are Bank of America, JP Morgan, and PNC Bank. What's interesting about PNC Bank, many people might not know it, it's a top 8 bank in the U.S. in terms of assets. It all benefits from the same catalysts. What makes it slightly unique is that they have a 20% ownership in BlackRock, which is the world's largest investment manager.
Yeah.
So it provides a little bit of diversification. That's also been a great investment from a stock perspective. And if we were to have corporate tax reform, PNC would benefit from paying lower domestic taxes, but it could look to monetize that asset and reinvest it either in share repurchases or into other earning assets. So that would be an added boost for the shareholder versus other banks.
Fascinating discussion. I wish we had more time, but you'll come back and provide me a chart next time for what you said this time.
Another chart to compare, yes.
Yes, that's good. Ben, thanks so much.
Okay, thank you.
Ben Gossack, he's portfolio manager for the TD Balanced Growth Fund at TD Asset Management.